Somewhere in your town, usually tucked into an unremarkable strip mall just like this one, sits a business quietly pulling in Apple-level profit margins. It doesn't have a flashy CEO and it doesn't make headlines, but it does generate cash every single day, almost entirely on autopilot. Before we break down exactly how these local cash machines operate, make sure to hit the like button, subscribe, and turn on notifications so you never miss an episode. We have been culturally conditioned to chase status. When we think of wealth creation, our minds immediately go to Silicon Valley, software apps, and venture capital. We want the glamour. This chart shows the harsh reality of that assumption. Over a 10-year period, 90% of high-risk tech startups fail entirely. Meanwhile, traditional service businesses boast a nearly 35% survival rate over that exact same timeline. A local plumbing company or a pest control route is 3 times more likely to keep its doors open than a trendy tech disruptor. The pursuit of novelty is, statistically speaking, a massive disadvantage. Our own vanity becomes a financial liability. We want to be associated with exciting, world-changing ideas, and that ego-driven blind spot causes millions of entrepreneurs to ignore the most reliable paths to cash flow. Enter the mundane monopoly. These are operations built entirely around unsexy, recession-proof chores. We're talking about laundromats, express car washes, and automated ice vending machines. Because business media focuses obsessively on celebrity entrepreneurship and magazine covers, the general public is trained to walk right past these assets. That creates a massive, low-competition gap for operators willing to do the boring work. This graph breaks down the actual financial appeal of that boring work. A well-run laundromat reliably pulls a 20 to 35% net margin. An express car wash can hit upwards of 60% EBITDA, which is the cash flow left over before interest, taxes, and depreciation. And if you look right here at automated ice vending, you see gross margins hitting 90%. By completely eliminating human staff, the operational costs drop to almost zero. True financial stability is sitting right out in the open. You just have to run towards the exact chores that the rest of the market's ego has trained them to ignore. To see how deeply the public misunderstands these models, we only have to look at the local express car wash. A modern express tunnel operates as an appreciating real estate asset wrapped around a subscription-based software model. Modern operators apply the Netflix model to washing cars. They push customers into unlimited monthly wash club memberships, replacing random one-off payments with guaranteed recurring revenue. With 3,000 members paying $25 a month, an operator locks in $75,000 in gross revenue. After lean operating expenses, a scaled express tunnel can generate $70,000 a month in profit purely from those subscriptions. By shifting away from single transactions, the business divorces itself from unpredictability. A rainy week or a drop in physical foot traffic no longer dictates the bottom line. There is currently a massive generational wealth transfer taking place across the country. Baby boomer owners are retiring and selling off their legacy, cash-heavy service businesses. The buyers stepping in are utilizing labor arbitrage. In this context, labor arbitrage means replacing expensive, unpredictable human attendance with automated systems, mobile apps, and cashless telemetry to manage operations remotely. Most of these target acquisitions look like this. They are severely outdated, entirely coin-operated, and heavily reliant on physical, manual labor to keep the doors open. Compare that to a modernized operation. An investor might spend $500,000 retrofitting an old full-service facility with smart infrastructure. By engineering out the human labor, that same business can comfortably net $250,000 a year. The real financial upside isn't found in simply buying a business. It comes from acquiring a poorly optimized legacy system and removing the human bottleneck. While we are entering a golden era for optimized mundane monopolies, this is a get wealthy slowly strategy. These operations require significant upfront capital to acquire. Once you own them, you have to implement strict digital management systems and stay on top of routine, heavy mechanical maintenance. The term semi-passive is widely misunderstood. It demands heavy, hands-on engineering and process building upfront. Only after the systems are locked in can the business safely run in the background. You do not need a novel, world-changing idea to succeed. You just need the discipline to solve a persistent, unglamorous problem for a local community. Pitching investors and chasing venture capital comes with a high-stress lifestyle. automated physical assets offer a quiet, boring peace of mind. True wealth is consistent and quiet. It's a system that reliably pays your bills via machines while you sleep. Every storage facility or car wash in your neighborhood is a quiet empire of recurring revenue. These businesses provide financial freedom to the owners who were patient enough to build them. Ultimate financial freedom arrives the moment you finally divorce your ego from your income stream. If you had the capital today, which O-ring business would you buy? Let me know in the comments below, and don't forget to subscribe for more breakdowns of how money really works.